Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, December 15th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, currently we have futures that are down pretty significantly. We got the Dow futures down 240 points, S&P 500 futures down 36, NASDAQ futures down the most of all on a percentage basis, down 135 points. That's a little more than 1%. Crude oil up 19 cents, kind of back to a key resistance level around the $77 a barrel area. We're at 77.47 this morning. The U.S. 10-year Treasury yield down about 2 basis points, 3.48%. So the bond market at this point still believing rates heading lower. A lot of folks continue to buy bonds. We did come off the low from earlier this week. We were down about 3.41, 3.42%. But we got up heading into the Fed meeting. We were back well over 350, close to 360. And now both the CPI and the Fed is in our rearview mirror. And the 10-year Treasury yield remains in that downtrend. So I would watch that range, about 3.40 to the downside and maybe about 361, 362 to the upside. That's going to be the key, I think, in the short term. Which way do we break? If we break to the downside, I think obviously the next leg would be lower. Whereas if you think rates are going higher, you would be looking for that breakout above 3.62%. We'll see which one happens first. Today, let's go through the agenda. We'll start off with the daily market recap, talking technically, EB top stocks, earnings spotlight, and the 3 you must see. Let's go ahead and get this started in just a minute. But first, I want to take you over to earningsbeats.com. All right, earningsbeats.com. Just wanted to point out for those of you who are new, if you just scroll down just a little bit here, you will see a major event that we have coming up on January 7th, Market Vision 2023. You can click on this link to register. This is completely free, no credit card required, but this is going to fill. It is absolutely going to fill. We'll be at capacity. So please make sure you register early, save your seat. If you click on that link, it'll give you a little bit more information about, what you can expect. Listen to this video. I tell you, the last 3 years had some pretty good predictions about the market. I feel pretty strong about 2023 at this point. We'll see what happens. And then if you scroll down, you will find that we've got Grayson Rose, Dave Keller, Julius DeKempenaar, all from StockCharts joining me for this event. Should be a great event. Really looking forward to it. Always enjoy getting together with those guys. A lot of very, very sharp minds. Of course, Dave is the host of The Final Bar and the Chief Market Strategist at StockCharts. And then you've got Julius, who is the creator and founder of the RRG charts. So if you're looking at rotation, there's no better person to look to than Julius. And of course, Grayson has been joining us for quite a while. My very first show over at StockCharts is probably back maybe 7 years ago. Grayson was my host. So Grayson and I go back a long ways. Always looking forward to see Grayson as well. Anyhow, please check this out and make sure you register. All it takes a name and an email address. Again, it will be starting at 9 a.m. on Saturday, January 7th. Looking so forward to this event. So please make sure you get registered. Okay, moving on to the daily market recap. So Wednesday, we had the Fed. The Fed has come and gone. Didn't really do much of anything different. I mean, when I was listening to Powell and looking at the language that was used, not really much changed. I think the Fed is acknowledging that the pace of rate hikes is going to slow, but that wasn't anything new. That's kind of what they've been telegraphing here of late. I thought maybe with a second consecutive lower than expected CPI report, we might get a little bit more out of the Fed. And I think maybe the market was disappointed that we didn't in terms of just being a little bit more dovish. So the Fed kind of did its thing. And when you look back at 2022, you can point to a lot of key pivots on the chart based on either the CPI report coming out or the Fed meeting. And this was kind of similar. You can see we had these moves higher with the CPI report on Tuesday morning, and then we sold off. And then going into Wednesday, into the Fed meeting at 2 o'clock, or at least that was the conclusion and the policy statement out at 2 o'clock. In the morning up until 2 o'clock in the afternoon, the market was doing pretty well, kind of moving back up. And then the Fed announcement came out, and there really wasn't anything that the bulls could grab hold of. And as a result, bears were in control, and down we went. The Dow Jones Industrial finished down 142, S&P 500 down 24, NASDAQ down 86, mid caps down 12, small caps down 10. So you really couldn't get away from the selling. Even though we were up heading into the 2 o'clock hour, it was mostly weakness. There was a lot of volatility, as there always is after the Fed announcement. But the overall bias was to the downside, no doubt. And we'll see whether or not some key support levels hold, because we are back down below the 20-day moving average on some key areas. Well, actually, we've got the NASDAQ that's about 40 points above its 20-day moving average, closed at 11,170, 20 days 11,130. So we have just a little bit of room there. The S&P 39.95 versus 39.70. And then we got the Dow at 33,966 versus 33,733. In each case, less than 1% to the 20-day moving average. And all of the major indices this morning are down close to or just above that 1% level. So it could be that we get gap downs and we lose those 20-day EMAs at the open. That'll be something worth watching. The mid caps actually did close slightly below the 20-day, 24.97, 90 versus 24.99. So just barely below the 20-day moving average. Small caps a little bit more so, 11.93 versus 12.04. So kind of mixed in terms of whether we're hanging above or below that 20-day moving average. I would also say the AD lines are a little bit different depending on what index you're looking at. I think the Dow, the AD line looks really good. Looking maybe at the small caps, maybe a little weaker. We were strong to open December, but really here in December, it's been straight down in terms of the AD line for small cap. So a little bit of a mixed picture here. We've been strong, strengthening, but we appear to be rolling over. I do also want to mention that it is option expiration week. Friday marks the end or the expiration of December monthly options. Talk to members. We have a Max Pain event on the Tuesday before every monthly options expiration Friday. So 3 days before. So we had that on Tuesday. And what I told members was after the big gap up that we saw on Tuesday, we had a lot of in the money calls. And so seeing some selling near term this week really shouldn't be a shocker. And so Tuesday we sold off all day. Wednesday, after making a pretty good move, 2 o'clock announcement came out. Again, we saw that big push to the downside. I'm still seeing probably 1.5 to 2% on the NASDAQ, maybe a little bit more on the S&P 500 potentially, that we could see the market move lower. So there's still going to be that pressure. Now I see, futures down. I'm not shocked because we are working our way back closer and closer to that max pain level. From a sector perspective, healthcare was the only group finished in the green yesterday. And you can see this is a group that has been very strong, starting to show some cracks in the foundation, though. They're higher prices, lower PPO rolling over. Got to be a little careful there. Communication services, though, down 1.3%. Financials, 1.25%. Materials, a little over 1%. And real estate, down just under 1%. So not a very good day. 10 of the 11 sectors lower. Healthcare, the only one to skate by. 10-year Treasury yield, got a lot of economic reports coming out today. And again, let me just make sure in the futures, 10-year Treasury yield, down 2 basis points right now to 3.48%. So that's where we are. Taking a look at some of the economic reports out today, and we have plenty that the market is going to see. First off, initial jobless claims be out around 8:30 this morning. They're expected to remain flat at 230,000. That's what we were last week. December Philadelphia Fed Manufacturing Index. November was minus 19.4. We're still expecting minus, but only 9.9. So a little improvement there expected. November retail sales expected to come in minus 0.2%. October was a rise of 1.3%. So pretty big reversal there. If we strip out the autos, November retail sales also expected to weaken from October's 1.3% gain. November retail sales less autos expected to rise 0.2%. Then we've got December Empire State Manufacturing Index. November was 4.5. We're expecting that to go negative to minus 0.4. November industrial production, expecting to see a rise of 0.1%. October was a drop of 0.1%. So not much there. Capacity utilization for November, 79.8 is expected. October was 79.9, so a little bit of a drop there. Recently, we were up just around the 80 level, so seems like we're beginning to drop a little bit in that capacity utilization. Finally, October business inventories. September rose 0.4%. That's what we're expecting for October as well. Moving on to talking technically. We've got the S&P 500. So here was the move. We tried to get through 4,100. And I think this 4,100 level is a really, really big level that we need to be watching. Let me tell you why. First of all, off of the August Jackson Hole speech that the Fed gave, Fed Chief Powell, you can see the huge selling that took place. That was the day of that speech. That was where he said more pain ahead. So the market sold off. We kept selling off. The reaction went where? 41.05 on the close. Then we kept going down, put in this positive divergence here on the low. See the lower lower price, higher PPO. We expected a 50-day test. We expected centerline reset. We got both of those. From there, we really don't know what to expect. That's the way I treat these divergences. I look for a reset and then let the market tell me what's going to happen from there. Well, from here, we actually had that October CPI report and the big gap up, and we've been trading more bullishly since then. So at this point, I think the S&P 500 is set up to continue to move higher off of this gap support. Here was the high, though. Where did we go? 4,100. We pulled back to almost 3,900. Then on Tuesday, with that CPI report, less than expected, we gapped up, got up to 4,100 again. To be exact, we were up to 4,100.96. Over here, we were at 4,100.51. Here, we closed at 4,110. So kind of have this range between 4,100 and 4,110 on the daily chart that needs to be cleared. What about the weekly chart? Well, on the weekly chart, look where the 50-week moving average is right now, 41.03. That would be breaking the downtrend line on the weekly chart. It would break the 50-day moving average, 50-week moving average. And then again, looking at the daily chart, there's a lot of overhead resistance here in this 4,100 to 4,110 area. So I think to the upside, it's pretty well set. If we can get through 4,110 and clear this level, it's going to look good not only on the daily chart, but also it'll begin looking much better on the weekly chart as well, breaking that downtrend line. Now, you can't assume that it's going to go through. We need to see it. It needs to confirm. But just want to let you know that that is a big level. To the downside, I think we got new news with that October CPI report, and then with the November CPI report also coming in less than expected. I think we've had two in a row. The Fed's been talking about needing to see a series of lower interest rates, lower inflation reports, and that's what we've been getting. At least we've had two, which is more than one. Will we get another one in January for the December CPI? I don't know. We'll wait and see. That's not going to be due out for another several weeks. Until then, though, I do think that this gap support right here is a major support level. And look, 50-day moving average is right there as well. 38.59 is your 50-day moving average. 38.59. Where did we gap up to? 38.59. So I think it's pretty clear, 38.59. I mean, you could throw in that 3,900 level because it's held so many times. We've seen so many pivots off of 3,900. But I would say 3,900 down to 38.59, 38.60. That's going to be big because there's your 50-day. We were to roll back over and go below the 50-day and that PPO turns negative again, that would not bode well. So I think we've got our lines in the sand drawn here on the S&P 500. I'd watch those levels very carefully. 3860 downside, 4110 upside. Let's see which one breaks. NASDAQ 100, similar. We did gap up above all of this resistance on Tuesday, but we couldn't hold it. So we had a false breakout, filled black candle. Not usually the best candles in the near term, and we did weaken off of that. Still holding the 20-day moving average, but this gap support that we need to watch on the NDX is at 11,350. We finished at 11,740. So we got, about 4%, 3 to 4% to go to the downside to get to that key gap support. Watch that. And then to the upside on the daily chart, I think it's going to be that open 12,141. If we can get back through that open and close above it, I think that would be a bullish development for the NDX. As far as the weekly chart goes, we've still got the 50-day way up at 12,773. NASDAQ has been underperforming the S&P 500. I mean, part of it I'm concerned about because it's growth oriented, but then also I realize that this is the fourth quarter, and the fourth quarter typically favors more value oriented companies like the financials, many of the industrials. And so I'm concerned about it. I'm watching it, but I'm not that upset about it at this point. But if we start losing key price support or gap support levels, moving averages, that's when things start to turn a little bit more bearish. I will say that the NASDAQ 100 has had problems getting through its 20-week moving average, as you can see, whereas the S&P went right through and right up to the 50, and it's been holding above the 20-week. So the S&P technically doing much better than the NASDAQ. How about the transports? This is a group that I've been watching. This group had not been performing well all the way into the end of September. But if you remember, on the S&P, we went lower in October than we did at the end of September. And when we look at the transports, we didn't. So we have a little bit of a positive divergence here in that the transports did not lead that last rally, or excuse me, the last drop to the downside, and instead have been rallying off of the September low. So transports, I think, look pretty good. Here was the gap up on November 10th. We did come all the way back down and test that at 13,750. We got the 50-day moving average right now rolling up underneath at 13,634. So that's going to be your area of support. To the upside, resistance is closer to 14,750. So 14,750 upside, 13,750 downside. Which one breaks? We're right in the middle right now. 14,277. All right, moving on to EB top stocks. Wanted to start off with the strong earnings chart list. What we do for our members is we put a list together of all the companies over the last 3 months that have beaten Wall Street's revenue and earnings estimates. Have to beat both. You can blow out the earnings, and if you match revenues, no good. Or blow out revenues and match earnings or miss by a penny. You might think, well, that's no biggie. Well, when analysts try to come up with valuations, it's pretty important that they be able to rely on management's estimates and things that they're giving the analysts. And so when they're not hitting their numbers, but then they're going to tell you what they're going to do next month or next quarter, how can you rely on it to do your valuation calculation? I think it's important. And some of this, I guess, stems back from my days as practicing CPA, but management integrity is a big thing. And so anyway, we put together the strong earnings chart list just so our members have, a list of companies that they can go to where we know the fundamentals were strong, at least in the last quarter. And then what I do is I go back and I annotate key levels. Like here, when General Mills reported, one of the lines I put in for support was gap support. And you can notice when we went down, went right back down to that gap support level and then bounced. So try to provide a couple of levels of support. Now, the other thing you can do with this, well, there's a lot of things you can do, but if you pull up this chart list, view all, and then hit the summary, remember, all of these charts are provided to members, and they can just download it into their StockCharts account. And then you can look at the stocks that have either done well or did not, or did well or didn't do well in a particular day. And you might be interested in them, you might not. Here, I can tell you with, I like to have the sector, the industry, and the scooter up when I look at this list. Just so I can see what was leading. I can quickly take a look what kinds of stocks were leading, which ones were lagging. Were the leaders mostly the high scooters? Yes, most of them were. You can see most of these are in the 90s. So that's where we're seeing a lot of the strength, which is kind of important. If we sort by the worst performers, notice here's a 1.4 on the scooter match. Internet stock, internets haven't been very good. But if you look down here, you only see a few 90s. You see a lot more lower scooter scores that are performing poorly. The lower scooter scores are telling you these are companies that have less relative strength. So this is one way to look at it. And you can, just sort it by scooter if you want. And you can see that at the top, most of these companies did well yesterday. We finished down on the day yesterday. Most of these scooter scores, though, that were up in the 90s that are on our strong earnings chart list, almost all of them were up. And one that was down right here, AEHR, is in the improving semiconductor group. So this is one that might actually get my attention because I'm looking for strong relative strength stocks that are pulling back. So if I pull up this chart, see what this looks like. We did get a 50-day test. You can see price support coming across here, and gap support is between about 2080 and 22. Yesterday's low, 2176, and we bounced off of it. Also, notice higher prices here, lower, the rolling over of the PPO tells us what? 50-day test and or PPO centerline test. There's your 50-day test. Here comes your centerline test. So yeah, this is one that I kind of like. Now I will give you this little bit of information as if you already didn't know, but I'm bullish. It's not that I think the market's going up every day, but I changed my strategy based on signals I was getting all the way back in mid-June. I was bearish the first 5.5 months, and I've been bullish since mid-June. The market's up, 10% or 8% or whatever it is off of that June low. So it has been heading in that direction with some ups and downs. But my strategy is I'm not shorting anymore. Once I figure out what I think is the direction of the market, I generally only want to trade in that direction. Because if I'm right, shorting, you're going against the grain. And I think so far it's proven to be a pretty good call from back in mid-June. So anyhow, I use these various chart lists. This is the strong earnings chart list. Then we've got the strong future earnings chart list. These are companies that did not beat, they're not on the strong earnings, but they still look good technically. Now, we don't annotate these charts, but we do provide a number of these companies, probably 400 or so, to our members as well for possible download. The last chart list I want to talk about at Earnings Beats is the short squeeze. So we put together this list of companies that are heavily shorted. The good news is that they're heavily shorted, but the bad news is many of them just keep going lower and lower. Look at Bed Bath & Beyond. This is the most heavily shorted stock right now, 45.11%. That's the short percentage of its float. And float's the available shares out there to trade. 45% of them have been borrowed and sold. That's a big number. And yet stock keeps going lower and lower. Some might say, well, why, with all these shorts, why wouldn't there be a short squeeze? Well, you have to wait for one to happen. Many times stocks are shorted for very good reason. So you got to be careful and not just assume because it's heavily shorted, it's going to go higher. You need to catch it when it starts to make technical breakouts and it starts to put pressure on the shorts. What pressure is being put on the shorts to cover right now? We had the lowest close of the year. Anybody who is shorted is making money. There's no pressure. You don't get pressure until you get some sort of a catalyst or you get a reversal and you start putting a lot of pressure on those who have shorted, where they start losing a lot of money. And then it forces them to trip over each other to try to cover and get out of the stock. And that's what does this. So this is Bed Bath & Beyond. The next one is Carvana. That one, again, just recently setting a new low. There's no pressure on shorts to get out, to cover. So you can go through and look. This one's 44%, but we go all the way down to 20%. I think there's like 35 stocks on this list. It's a great list to have. Many times when the short squeeze stocks start to go, they all start to go. Now, one that I really like that I'll just point out is Wayfair. Wayfair, you can see here, we had come up here a few times to about $42, $43. Notice that was also the lows over here. So if we can get through about 43, 44, anyone who has shorted in the last 3 months will be underwater. I'm looking at the volume, which is getting stronger and stronger, but we haven't had a breakout. We need the breakout. PPO looks good. If we can get a move up in Wayfair, and I don't like to buy these stocks anticipating a breakout because a lot of times they don't do it and they just go lower. And then you're in this free fall. You know, when we went sideways here for a while, if you anticipated some kind of a breakout, look what happened. 120 down to the 40s in 5 weeks. You don't want to be in this if it rolls back over again. You want to wait and make sure you get that breakout. All right. Quickly, as far as earnings go, Lennar reported yesterday. So let's see what kind of reaction we're getting for Lennar heading into today. Down 3%. TCOM also reported after the close yesterday. This is trip.com. It's up slightly, not much. And the other one was Nordson Corp, NDSN, which is up 3%. So those were three. This one actually trying to make a breakout. Watch that 245 to 247 area. If we can get through that, this one could run. All right, let's take a look at the three you must see. First, I'm going to show you on semiconductor, and I'm going to also bring this up on a relative chart. A couple of days ago, we were almost ready to break out, and now we're all the way back down at this gap support area and price support. So we're in this gap support zone, and then price, this was the prior high, which we cleared on this gap up. 67.50 is a pretty big level, and we're right there. So on is one I would keep an eye on. Next up, CZR. Never like to see false breakouts. And when we look across here, 55 has been a really big level on Caesars. On Tuesday, it went up and was up over 56 or around 56. Let's see where that was. High was 55.51. But we were in breakout mode intraday and we failed. When that happens, you want to be very careful. And you can see what happened yesterday. Stock down 5.5%. Back down to the 20-day moving average. I think this one very well could break out, but we need to see the breakout. We don't like these false breakouts. And then the last one we'll look at is DLR, moving into the real estate area. This is Digital Realty Trust, another one where we tried to move up, breakout, failed, came back down, and actually closed at the lowest level in about a month. I think we could head back to this gap support level around 100, so watch that. All right, that is it for me. I appreciate everybody tuning in. Remember, Market Vision 2023 coming up on January 7th. Make sure you register. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.